Morning, everyone. Lovely to see all of you here. Before I start the presentation, I've got 10 quick slides. I just wanted to address a little bit about what Shen asked about diversification, because we get this question a lot. I think one of the questions that we often get asked about, also at the board level, is, are you guys doing too much too soon and spreading yourselves too thin? Should you not specialize in certain things? And I think the way we look at that is the way the board addressed it. If you look at the best-in-class capital managers, they actually do much more than what we do. They are diversified across products, they are diversified across sectors, they are even diversified across strategies. So the biggest boys have actually successfully built different product streams, and in the course of doing so, built resilience into cycles, real estate cycles, capital cycles, and so on and so forth. So I think I'd like to say that we are on that same path. We aspire to have the same degree of resilience. But as the board has guided and cautioned us, you have to do that judiciously, carefully, and not try and be all things to all people at the same time. So it is indeed a careful balance that we have to strike. And if you feel that we are pushing too many buttons at the same time, we welcome that. Let us know and challenge us to prove to you that we're not doing that. Thank you. Okay, so I'm going to talk about how we are positioned for growth, leading on from Chee Koon's opening. I'll take a couple of slides just to remind everyone what we have accomplished since we sat down together 2 years ago at the 2022 Investor Day. And I'll do that using the 4 verticals. First off, private and listed funds management, including the important announcement with SC 2 days ago. We have now grown funds under management by 30% to 113 billion on a fully embedded basis. In the last close to 3 years, we have raised 11 billion in equity, both from our listed and private funds. And FRE has grown by 7% over that period of time. You may ask us why the FRE is slower than the funds under management, and I think I would point you to the forward-looking metric of embedding FUM, committing FUM that will deliver future FRE. So if anything, this is a forward indicator of the future earnings and fee income that will derive once that capital that we have raised begins to get deployed and starts to generate fee income. So from a private and listed funds management, I actually think we've done pretty well. Turning over to our operating platforms, lodging management has recovered strongly from the challenges posed by COVID. FRE up almost 100% since 2021. And Kevin and his team have been busy signing units, but also equally important, opening new units, delivering resilient and stable FRE. As you know, these contracts are typically 5 to 10 years in nature. Revenue per available unit is increased by almost 50%, and we are committing more than $150 million to continuing to renew the portfolio to ensure that the product is safe and delivers the value for our travelers. The confidence in lodging management has been crystallized by Kevin having the ability to come out to say that we are now doubling our revenue targets from 250 to 500 million by 2028. That is not any mean feat to deliver, but that indicates that the confidence we have, as Miguel said, in our global operating lodging and living platform. As a key enabler, commercial management is picking up its share, delivering growth of 19% in fees earned. We are the largest commercial landlord in Singapore. We are the largest foreign institutional commercial landlord in China. That gives us scale, gives us network advantages in growing our platform in an asset-light, ROE-efficient way. So I just want to start off this next chapter of what I'm supposed to talk about, which is how we are going to grow going forward, by just reminding you guys that as far as our 4 key income verticals are concerned, despite the difficulties we've had, despite the headwinds, COVID, inflation, geopolitics, I would like to think that we've actually delivered credible growth across all of our key 4 verticals. And if Gabriel's point about TSR holds true, we fundamentally believe that the stock price is undervalued, which is why Paul has been buying back shares at a healthy clip. Okay, so let's stop there and then turn the page to what we want to do going forward, which is why all of you are here. There are 3 primary growth drivers that I would like to touch on today. The first of these is investment thematics and strategies. Now, Chee-Koon talked a bit about this, and when we sat down in 2022, we talked about 7 mega trends. I have distilled this into 3 Ds: demographics, disruption, and digitalization. They should come as no surprise to you. This is not our proprietary to CapitaLand. Many capital managers have similar forms because I think we see the same secular trends, investable themes that many other investors and capital managers see. In demographics, it's about how Asia is aging, how we are increasingly focused on our health span rather than lifespan, and as we get older, the shift towards income-focused products will continue to grow. What does that mean for us in terms of demographics? We are investing into the lodging and living sectors. We are investing into wellness. And of course, we have our REITs that generate stable, predictable yield and DPU growth that is a testimony to our ability to do so. Second D is disruption. Disruption stems from all manner of VUCA causes over the last 3 years: inflation, geopolitics, climate change, etc., etc. And one of the manifestations is that we've had to reprice capital costs substantially, both on the debt side, but also on the equity side. Disruption from geopolitics and the need to reshore, friendshore has also forced supply chains to be rewired, remapped. And as a result of that, we are investing heavily into strategies such as private credit, special situations, and logistics and self-storage. And last but not least, certainly as Gabriel mentioned, digitalization is a fundamental driver. There will be exponential growth, we believe, in data storage requirements, whether for AI or conventional storage. And we are investing heavily into our data centers and renewables platform. Now, I just want to ask you to focus on the right-hand side and just to remind you and show you that within these strategies, we cover the entire return spectrum. So if you look at our REITs and our core products, these are designed to give you steady DPU yields, distribution yields, but also with products like COREF, a return of, say, 8 to 10%. On the other end of the spectrum, recognizing that there's disruption and a desire for higher return, we have our special situations as well as our opportunistic products. These are designed to earn upwards of 18%. And then the strategies in the middle, which are thematic in nature, are designed to deliver more value-add returns of between 12 to 18%. So one way to think about this is, well, you guys are doing everything. The other way to think about this is we offer a diversified product suite across our private and product funds and public funds that give people the ability to choose and decide what it is that suits their risk and return, depending on where they are, and also it gives them the ability to pick from these emerging trends, investable trends, but what it is that appeals to them. I'm going to take the next 5 minutes to talk about 3 of these trends. We believe in these trends with high conviction, one each: demographics, digitalization, and disruption. The first of these is lodging and living. We have an aging population in Asia. 1 in 6 people will be over 60 years old by 2050. I will certainly be one of them. We debated long and hard about what buy leisure means, or be leisure, and essentially it is business and leisure coming together as one. I, for one, increasingly use this when I travel for business. I tack on another 3 to 4 days at the end of it and spend my time in the hotel exploring wherever I am. And so this is a huge market, and it allows us to leverage the product and the operating platform that we have through Ascot to deliver platforms and products that suit folks who want to engage in leisure travel, experiential lifestyle, sustainability, and wellness. Right? These are important trends that we are seeing and we believe we can invest into. We currently manage 17 billion today across 2 of our listed funds, including our strategic partnership with Suchard and his team in Japan, which we believe is incredibly strategic from a lodging standpoint and also from a Japan trend standpoint. And we have 3 dedicated private funds that invest into this. What are our strategic differentiators, as Judy talked about earlier? What is it that we have and possess that allows us to believe with confidence that we can win? Right? And this starts and ends with Ascott. We are arguably the largest long-stay, flexi-stay platform in the world. We have a diverse set of brands and are adding more every day that caters to the preferences of a diverse travel set. And the loyalty program that Ascott has built is starting to really gain momentum in driving EBITDA margin growth as we start to cut out middlemen from platforms and agents that charge high middle income fees. So this gives us high conviction that living and lodging is indeed a thematic that we can play in and we have a right to win in. The next one of these in disruption is logistics. I talked about that earlier. We've got supply chains, friendshoring, nearshoring. This is a real trend that is happening. All of us in our respective countries and markets are seeing evidence of this. Unfortunately, it's actually manifesting itself in higher inflation because reprogramming of supply chains is inherently inefficient. Technological disruptions are driving the need for last-mile delivery, hubbing, analytics, robotics, and so on and so forth. And you can see from the chart on the right that the global logistics market size is growing and growing twice as fast in Asia compared to the rest of the world. So we believe that this pie is growing and we have the ability to invest into this growing piece of the pie and deliver value. We've got 11 billion in funds under management today. 4 of our trusts invest in logistics properties. And we have a number of dedicated private funds in Japan, in India, now in Southeast Asia, in Korea, all of our core markets that deliver customized logistics product differentiation. What are our strategic differentiators? We offer innovative products from smart logistics, automation, analytics, and flexible cost solutions, as I mentioned. We have 2 very value-adding partnerships. I'll talk a little bit about platforms in a minute. Through Ascenda's First Space, which is a joint venture we set up in India many years ago, and has culminated in us being a top 3 logistics player in India today. And more recently, through the SEA Logistics Fund, we have a strategic partner in Alley Logistics Properties out of Taiwan that allows us to design a highly compelling product in the use of smart and automated logistics that is now taking shape in Thailand, Malaysia, and now they are venturing off into North Asia, Japan, and Korea. The third of these is data centers, and building on the theme of digitalization. What's the industrial logic? The industrial logic is that global DC capacity demand is exponentially growing. And again, when you look at what Asia is promising to deliver, a more than 20% growth in co-location market size in the next 5 years. So similar to logistics, you may argue that there's so many players, it's getting crowded, everyone wants to play. But the pie is big enough, I think, with the rate of growth, that if you have the right capabilities, you have the right access to location, and you have the access to power, you can play and play successfully. And we believe we are one such entity. We've got 6 billion thus far in assets under management, a number of dedicated private funds, 2 of our REITs investing in DCs, and we are currently on the road marketing 2 additional DC funds within Asia. What is our strategic differentiator? A little known fact for many of you is that we actually now have 27 data centers across our global footprint with over 800 megawatts of power on a fully developed basis. We have a complete in-house team able to design, develop, lease, cater to co-location, cater to hyperscale and enterprise solutions. And we are currently building a renewable energy expertise because we believe that this will be highly complementary to any DC product that's out there. The second of these key drivers is our operating platforms. Now, what we believe operating platforms offer is a value-enhancing proposition that drives the value of the real estate. And this is especially true when you're dealing with operationally intensive and complex sectors. And again, this may be not well known to you all, so I hope this gives you some sense of the ability that we have to partner with best-in-class operators to deliver value-enhancing propositions. In lodging, we have our Ascot platform encompassing all of its brands. We recently signed a strategic partnership with Xinjiang in China to grow the Quest brand on a franchise basis. In wellness, we have the Pruksa Group out of Thailand and their Vimut brand of hospitals. Seawell is investing into an orthopedic hospital in Bangkok. We are product and operator agnostic in the Seawell Fund, and so look for us to partner with more best-in-class operators as we develop this very interesting and fascinating thematic. In self-storage, we've invested into Extra Space, which is active in across 6 countries. And this is a pan-Asian strategy that we've invested into with APG. Industrial and logistics, we have, again, as I mentioned, 2 key partners, Ascendas First Space in India, as well as ALP in Southeast Asia. And then 2 very important and strategic in-house platforms that we have grown from the ground up in our data center operating platform and our incredibly successful commercial management platform in China and in Singapore. You may notice that there's a work in progress sticker under private credit, and that is there for a reason. I will stop. But I just want to leave you with this, that a key component of why we think we can succeed is that we believe that in the sectors and thematics that we have highlighted, they are operationally intensive, highly competitive. You need to know what you're doing in order to drive the best value out of your assets. And this is where the platforms come in. So if you question us on our right to win and our right to play, this is where I would point you to, alongside the fact that we have the products and the capital that we are raising to deploy into these strategies. The third driver is simply the fact that we are Asia Pacific's largest REIT platform. Now again, that is something that we never take for granted for 1 second. How through the family of our 6 in-house REITs and now together with SC Capital's Japan Hotel REIT, second largest J-REIT, hospitality J-REIT in Japan, with a fantastic track record, we are signaling that we have the ability to roll out a pan-Asia platform of perpetual capital, catering to a very specific capital pool that is targeting yield return. We are now active in 3 markets, Singapore, Malaysia, and now with SC Capital, Japan, and we want to do more. We see the potential to do more. We think the REIT market has room to grow. We are 300 billion now, and we think that the market has room to grow 8% per annum for the next 5 years. So this is a pie that is growing across Asia. I don't think we should be limited to the S-REIT market. In fact, I believe the S-REIT market is pretty crowded. But we have the opportunity to take the product and our reputation and our sponsorship and our high governance into markets such as Australia, China, and even India. So this is, I think, a sleeping giant that we have, a crown jewel of our business that has a tremendous potential to add to our growth story on the public fund side of the business. Okay, so how do we distill all this down? As Chee Koon alluded to earlier, we are positioning the business to allow us to grow. On the left-hand side, I've got a map of the world with our key markets and geographies color-coded by, I would say, growth intensity. So dark green for maximum growth, light green for light growth, and then gray for moderating or neutral growth. There are only two countries that are gray. One is China, and the other is Singapore, for different reasons. In China, the reasons are well documented. I won't go into it. We're not saying we're going to shrink China, but we are saying that we are going to moderate the proportion that China will play as we approach 200 billion. Singapore's a fantastic market for us. It's our home market, but it's small. And as I mentioned, we are the largest private landlord, or as it is. So for us to harbor aspirations of further intensifying our presence in such a small market, I think it's unrealistic. Instead, what we want to do is to use our reputation and Singapore as our home base to expand into Southeast Asia, including Malaysia, Thailand, and Vietnam. And of course, you see the three markets that we are pressing the gas on as quickly as we can. In India, Japan, Korea, and Australia. Forgive me, 4 markets. On the right-hand side, I want to distill the 3 growth levers that I talked about earlier into how we are applying these growth levers into our strategy to grow our shares in our various countries and see how they come together. So the first of these is your thematics and strategies that I talked about. The second is the operating platforms that we have at our disposal to convince capital pools to come alongside and allow us to invest for them and drive return. And obviously, the products on the REIT side that we already have and believe we have the potential to introduce in these markets. On the left-hand side of the table, you have the current percentage contribution to our 113 billion of FUM today, and the target that we've set for ourselves, 200 billion by 2028, and those percentages that we have set for ourselves to deliver for our shareholders. And you should see that the percentage growth will correspond to the colors that you see on the left. Okay? So you look across and you see the thematics that we are investing into with the products that we have. We will apply the platforms that we have at our disposal, again, through partnership, through co-ownership, through joint ventures, alongside our internal platforms, CLI CM, CLI DC, along with Ascot, of course, and the products that we have on the public side that exist today, and also the products that we are thinking of putting together. So I hope that gives you a sense, right, in the 12 minutes that I had, to try to encapsulate the 3 primary growth drivers that we will use to deliver 200 billion to our stakeholders and shareholders. Right? It's very much a work in progress, very much a dynamic, fluid situation. We are faced with an incredibly uncertain, volatile future. But again, as we all believe, this is where you separate the men from the boys. This is where a strong team with the senior hires we have made on the country side, on the product side, we believe gives us every confidence that we can outperform our peers and deliver this target to you by 2028. I have 10 seconds left. Anything that I would like to cover before I shut this down? If not, thank you very much for your time, and I'm sure everyone's waiting to hear from Janine.